The Election Commission has announced that polling for the 15th general election will be held on Saturday, November 19th. The nomination date has been set for November 5th, which allows for 2 weeks of campaigning. During a press conference at Menara SPR today, EC Chairman Tan Sri Abdul Ghani Saleh also announced that the writ issuance falls on October 20th, while early voting will be held on Tuesday, November 15th. Meanwhile, he said the state by-election for Bugaya and Sabah, which was left vacant following the death of its incumbent Datin Manis Muka Mawadara on November 17th, 2020, will be conducted simultaneously with the GE15. Abdul Ghani adds that the closing dates for early voting applications are October 23rd for Malaysians residing overseas, October 26th for agencies and organisations, and November 2nd for media, army, police force and election officials. A total of 21.17 million are eligible to vote in the GE15, with 363,515 officers appointed to handle the general election and the Bugaya by-election, according to Abdul Ghani. He adds that both are estimated to cost a total of 1.01 billion ringgit. The G15 was set in motion after the EC received the notice of dissolution of the Dewan Rakyat from the Speaker on October 11th. The Commission also received notices of dissolution from the State Assemblies of Pahang and Perlis on October 14th and subsequently Perak on October 15th. The GE15 will see the highest number of state assemblies not dissolved concurrently, 10 in total. They include 3 Perikatan Nasional coalition-led states, namely Kelantan, Terengganu and Kedah, as well as 3 Pakatan Harapan-led states, namely Penang, Negeri Sembilan and Selangor. 4 other states have held their state elections after the GE14, namely Johor, Malacca, Sarawak and Sabah. A total of 222 parliamentary seats will be contested in the GE15, as well as 42 state seats in Pahang, 15 state seats in Perlis and 59 state seats in Perak. Digi.com saw its net profit for the third quarter drop 15.5% year-on-year to 264.5 million, mainly due to the tax provision from Cukai Makmur and higher net finance costs, coupled with higher net loss on fixed assets written off and lower interest income. Revenue for the quarter dipped to 1.53 billion from 1.58 billion previously, as total service revenue declined by 1.8% year-on-year, despite robust postpaid, business-to-business and fibre growth. Despite the softer earnings, Digi declared a third interim dividend of 3.4 cents per share. Acting CEO and Chief Marketing Officer Praveen Rajan says Digi sees continued demand for mobile services across all segments. He adds that in light of current global uncertainties, the telco will remain disciplined in cost management while continuing to invest in strategic growth areas and modernizing its network. Digi invested a total of 173 million in capex for the quarter. Postpaid subscribers grew for the 8th consecutive quarter, with 164,000 year-on-year net additions to a total of 3.4 million subscribers, while its prepaid base saw 177,000 year-on-year net additions to 7.3 million subscribers. Blended average revenue per user, however, declined 2 ringgit 50 cent year-on-year to 40 ringgit, mainly due to the impact of lower prepaid ARPU as the Jaringan Prihatin program ended. Praveen also added that the discussions related to the 5G access agreements with the relevant parties are progressing well, and the telco is looking forward to completing the proposed Celcom-Digi merger this year. 7-Eleven Malaysia Holdings share price jumped to a record high on Thursday, rising as much as 8 cents or 4.2% to 1 ringgit 98. This was following reports that an American PE fund is said to be eyeing the group's pharmacy business, with negotiations reported to be in an advanced stage. The counter wasn't able to hold on to its gains, but still managed to end the day 3.68% higher at 1 ringgit 97, with 799,000 shares traded. It was reported in The Edge recently that the Carlyle Group is believed to have submitted a bid to buy Caring Pharmacy Group from 7-Eleven. According to sources, Carlyle made a 1.3 billion ringgit offer to buy the retail pharmacy chain, though 7-Eleven is seeking between 1.5 billion and 1.8 billion ringgit. Such developments may also bode well for 7-Eleven shareholders, who may see a bumper dividend should the sale of Caring turn out to be successful. 7-Eleven owns 75% of Caring, and the convenience store operator's largest shareholder is Berjaya Corp founder Tan Sri Vincent Tan, who controls 41.095% of the company. Coincidentally, the share rise in the stock's price comes as the company resumes its share buyback program following an 18-month pause since April 2021. According to 7-Eleven, the company spent 3.9 million from October 7 to October 19 to buy 2.38 million shares at between RM1.55 and RM1.88 each. Annual total industry volume could hit a record high in 2022, with analysts expecting another quarter of stellar earnings from the auto companies on sustained delivery momentum. According to the Malaysian Automotive Association, the number of cars sold in September jumped by more than a third, or 34.63%, to 67,659 from 44,227 a year earlier, as automotive companies continue to fulfill many of the bookings received prior to June 30th. Year-to-date, the sales volume up to end September was 62% higher than the same period in 2021. MAA's target for 2022 is 630,000 units, while for 2023, that number is 636,000 units. Investment bank analyst Muhammad Afif Zulkifli made no changes to his 2022 forecast of 600,000 units, which assumes industry sales would normalize back to pre-pandemic levels following the absence of the sales and service tax exemption that expired in June 2022. However, he does not expect a sharp decline in sales as automobile players are still registering a healthy daily order rate even after the end of the SST exemption. Investment retained its overweight recommendation on the automotive sector, as did Kenanga Research. Kenanga's analyst Wan Mustaqin Wan Abdul Aziz has a 2022 TIV target of 650,000 units and a 2023 TIV target of 660,000 units. Hong Leong IB analyst Daniel Wong expects an upside to his 2022 TIV forecast of 600,000 units, as he expects continued high order deliveries in coming months as OEMs accelerate production and imports to fulfill the huge order backlogs and reduce the waiting period. K1 Technology is planning to form a JV in Vietnam to conduct cloud computing business. According to a BOSS filing, K1's wholly owned unit G-AsiaPacific inked an agreement with Vietnet Distribution Joint Stock Company on October 20th. The proposed name for the JV company is G-AsiaPacific Vietnam, which will be 51% owned by GAP, with the rest held by Vietnet. The initial capital contribution of the JV will be $300,000. According to K1, the cloud market in Vietnam is one of the fastest growing in ASEAN, driven by its accelerating digital transformation. The group adds that the multinational cloud computing partners of GAP, namely AWS, Google and Microsoft, have big footprints in Vietnam for good reason. K1 said Vietnet will focus on developing the business through their wide network, while GAP will provide the technical support to secure the business. The proposed JV is expected to contribute positively to K1's earnings for FY23.